Inflation is embarrassingly high for the Reserve Bank because the 13 interest rate rises we've had, and they've been going on for over 2 years now, hasn't seemed to quell inflation, which rose a little bit over the last quarter. So what's ahead for our economy, for inflation? How's that going to affect our property markets? That's what Dr. Andrew Wilson and I discuss in today's Property Insider chat. We also discuss what's happening to house building costs, and there's some good news there, and also the auction results. And there is also clearly good news there if you're interested in our housing markets. So if you are, why not subscribe to this YouTube channel, and we'll let you know once a week when a show comes out if you click the little bell icon. The government's claimed that billions of dollars in cost of living measures are helping fight inflation. Well, they're in tatters after new figures revealed a jump in the latest consumer price growth figures. And that's made some economists think that that could force the Reserve Bank to deliver another rate hike. Official data last week revealed inflation jumped to 4% in the year to May. That's up from 3.6% the month before. As the end of energy rebates drove energy bills higher, petrol prices soared and rents continued their rapid upward march. Now, with inflation trending higher for 3 consecutive months and now being well above the 3.4% it was only last December, analysts have now delayed their forecast for any mortgage relief until well into next year. So what's behind all this? And what does it mean for our housing markets and our economy? That's what I'm going to ask Australia's leading housing economist, chief economist of My Housing Market, Dr. Andrew Wilson. Hi, Andrew.
Yes, good day, Michael. And I don't think we were terribly surprised by higher inflation.
You predicted it, Andrew, didn't you?
Well, look, and I think it's just showing how nonsensical those predictions of lower interest rates have been generally in the media and from some. And there was never really a prospect of lower interest rates because of the underlying pressures that remain in our cost base, in our economy. And they're unfortunately coming to bear again, where, as you mentioned, we saw inflation rise, perhaps concerningly. Well, we had headline inflation rise. That was the big jump, Michael, up to 4% now. And that's a big rise following, and that's the annual growth in inflation, headline inflation. And that followed the 3.6% increase over April. So it was a big jump. I guess the better news there was that headline inflation fell from 4.1 to 4%. And of course, the underlying inflation measure is the preferred measure of the Reserve Bank because it takes out the volatile items. But the problem is that the volatile items are fuel particularly, and that had a big increase. And that's why we did see the headline rate really rise strongly. Fuel was up 9.3% over the year, and that compared to the 7.4% rise over the previous month. And that's what pushed the headline rate up. It wasn't included in the underlying rate because it's part of the volatile factors in the trimmed mean, which takes out the volatile factors from that particular measure. But it really does put the Reserve Bank between a rock and a hard place if you've got underlying inflation rising, particularly reflecting essentials such as fuel and housing, Michael. And housing was up 5.2%, as you mentioned. Rentals are driving that. That's what we measure for housing inflation is rentals and house building costs, which we'll look at in a sec. But up by 5.2%. So that was sort of taken out of the underlying rate, which gave us a better result. But the headline rate was a bit of a disaster, really. But the point with our inflation data, Michael, is that it's a bit backward looking because we already know what fuel prices are doing. We know what the price of oil is at the moment. We looked at that last week. And the price of oil has continued to rise. It's now consistently above $80 US a barrel. But it's not so much where it is now, Michael. It's where it was a year ago. So we do know the factor that will work its way into the next inflation number, which of course is for June, and that will come out in a month's time. But at the moment, not at the moment, but fuel costs over June in terms of the US barrel price for oil is 12.4% higher than what it was over June last year, Mike, when we had lower oil prices. And that will again work its way into the headline inflation number. So the prospects are, of course, we're seeing no relief from housing costs, particularly for rents. And we're releasing the My Housing Market rental report this week. And that will again likely show upward pressure on rents. So the prospect going forward is that this isn't the end of higher inflation. Maybe the headline rate will remain reasonably stable, but that's because we won't be counting housing or fuel costs. But consumers out there know that that's a significant contribution to their financial position is the cost of fuel and of course housing. And also as petrol costs rise, as fuel costs rise, that has a downstream effect on prices generally. So this is a difficult position for the Reserve Bank when we've got headline inflation breaking out, but more steady results from underlying inflation. But as I said, and if we can look forward, Michael, to what the comparisons with the oil price last year going forward in the second half of the year are. And, July and August and September were actually periods of lower oil prices. So we would really have to keep our fingers crossed that oil prices start to fall below that $80 a barrel mark, which it's been tracking at for the last couple of weeks. In fact, we'd be hoping that it would get under $70 US a barrel to take some relief to provide some relief to consumers from higher inflation. But these were, sobering numbers. The Reserve Bank has said, as we discussed last week, Michael, the governor said that, has said that they need a lengthy, whatever that is, or a more consistent period of higher inflation before they decided to change monetary policy. But, they're getting that now, Michael, and I think another couple of months of higher inflation would really, motivate them to act. In fact, there'd be questions asked if they didn't act, particularly as our interest rates are still well below the US official interest rate. So maybe we're paying a bit of the price for that. And, our economy is still, very, very strong. Unemployment rate actually fell over May down to 4%, which is still a very low number, higher than a year ago, but still a very strong economy. So, there's no real sense that higher interest rates, have had any impact. And, that's starting to sound a little silly when we talk about the lagged effect, that's still to come from higher interest rates. What, it takes 2 years for interest rates to start to work, and we haven't had a rise since last November. So a lot of the dogma that's coming out of, some analysts and the media really is looking quite ridiculous at the moment. And unfortunately, inflation is certainly not tamed. And the prospects are worryingly that it will continue to rise over coming months, Michael, even if we do get some relief from oil prices, because I don't think we're going to get any relief from particularly the rental market anytime soon.
Well, you're mentioning how our economy is doing well. Rising interest rates aren't affecting everybody.
No.
They're the younger people with no debt, and some of them have got parents giving them extra money as well. And then there's, of course, the baby boomers, many of them with no debt against their homes and enjoying their lives. So there's lots of people out there spending again. You just have to go to the local shopping centres and you can see it. Now, of course, we're not downplaying the hurt that some people are suffering with the rising cost of living, but overall, there's more of us and we're spending up pretty big, Andrew.
Yeah, that's right, Michael. And let's remember a few things in regard to interest rates without downgrading the impact that higher rates have had on people, because it is about where you are now, not really where you've been. But 10 years ago, at the previous peak of the interest rate cycle, rates were actually higher. Official rates were actually higher then than they are now. And that was at the peak of a very strong economic period for Australia, of course, the second mining boom. We started at zero, Michael. So, we started with zero interest rates, and we're now up just over 4% official rates, which, as I said, is lower than 10 years ago. We've had a very, very strong economic performance post the COVID lockdown period, post the pandemic. So there's still plenty to be bright about, and we also have and the Reserve Bank are finally conceding this, that consumption is still pretty solid to strong. We can see that in retail sales that are holding up at the stimulus package levels, and also very strong sales occurring in our housing market, which, as we saw in the latest My Housing Market house price report, we're on track for at least a 5 to 10% growth in national prices again this year. So plenty of consumption happening, plenty of positivity from consumers out there, and unfortunately, that's part of the reason why we're seeing higher prices as well. And that's the task of the Reserve Bank, is to get inflation under control, which really you'd have to question that has occurred so far over this cycle.
Well, the Reserve Bank's going to meet again in August, and I guess between now and then there's going to be a number of results coming out. They're going to look
Yes.
at carefully. Monthly housing spending's coming out in a couple of days' time. The unemployment figures coming out in the middle of July. Retail sales figures, they're going to look at how that's going. And then, of course, as you said, there's going to be the June quarterly and the monthly CPI figures, and we're going to be back each week talking about those. But another set of figures that came out recently, and I know My Housing Market keeps a careful track of, is the cost of building dwellings, Andrew. That's skyrocketed in the past. What's happening now?
Just before we go there, Michael, you're so right about the data that will be coming through. And one of the things I think we spoke about last week was that the Reserve Bank mentioned that they'll be looking very closely at those June quarter numbers. And I sort of queried that about, well, what's that going to add to what we already know? Because June quarter numbers will come out after we get the June monthly numbers, which, as I said, are likely to show a higher result. And it's going to be backward looking. It's going to look at April and May as a combine for the inflation rate. So to me, it sort of sounded like that maybe they were expecting, perhaps if they did get higher inflation numbers, they could look back to the previous data that's covered in the June quarter, to give them some relief, or at least some sense that, well, we can still wait and see how things pan out. But I'm not sure that having the monthly numbers, which we now focus on, means that the precedent should be given to the quarterly numbers. It just seems a little bit logical to me. But as you said, Michael, housing costs have been one of the drivers of the inflation rate. That covers rents and house building costs. That's what the ABS used to measure housing costs. It's rents, and it's house building costs, not apartment building costs, but house building costs. The problem with rents is, again, that's a bit of a backward-looking scenario, because they look at the whole rental market, and rents in those that aren't newly advertised, which is what My Housing Market covers in terms of its rental model, tend to lag what's happening in the real market, as those on leases have them renewed, and landlords renew them based on what's been happening in the market. So again, that's a bit of a backward-looking measure. But we have seen some better news in terms of house building costs, Michael, which, as you mentioned, they skyrocketed following the previous government's home builder policy, which was a stimulus package through COVID. Of course, it created a lot of demand, brought a lot of demand forward, and we didn't have the building materials or labour to match that demand. So house building costs went through the roof, and remarkably high. When we look at the actual data, it's only been the actual index of house building costs run by My Housing Market. We can see that it's only now that we're starting to see a consistent fall in the index. It's still tracking well above its peak points in terms of growth, but the trend is now downward. So we are starting to see some adjustment in house building activity, and its impact on house building costs, which is a positive, because we are chronically undersupplied with housing. So we don't need the constraints of higher prices making that position even worse. But when we look at the annual growth in house building costs, we can clearly see after a bit of a hiccup earlier in the year where that the consistency of falling annual growth in house building costs has continued over the previous months, and we had quite a sharp decline over April. House building costs over the year to April were at 3.3%. So that's the lowest really that we've had since the pre-COVID period, and certainly well below the 23% increase we had over the middle of 2022, which was the peak of that surge in house building costs, in housing inflation. So good news there for not just the building industry, that although these are still above what the long-term house building cost scenario typically is, which is quite low. It's a highly competitive industry, but it's certainly becoming more manageable, and the trend is clearly downwards. So we can, hopefully that'll improve what's still a very subdued home building environment, particularly through approvals. A bit more confidence with builders being able to manage the finances of building. But of course, the other point is that it will take some pressure off the inflation rate, which has been stoked to some degree, well, to a significant degree, really, by the outbreak in house building costs.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, we always discuss the auction results because that gives us a good in-time indicator of how people are feeling on the ground. Sellers, are they prepared to let their properties move on so they can move on with their lives and upgrade, downgrade? And buyers, how deep is the market? And wintertime, usually auction results slow down a little bit.
Yes.
I guess we're in the depth of winter, especially here in Melbourne, Andrew. How did the
Yes.
weekend auction results go?
Another good round of results. I forgot to wish you a happy new year, Michael, because it is the beginning of the new financial year.
Yes.
So we've waved goodbye to 22-23, and we're now horrifically into 23-24. I'm a year behind. We're now into 24-25. Can you believe it? Halfway through the decade. But and you're right. We're now in a period where we normally see a significant falling away of listings, particularly into July, end of June, and the market starts to reconsider its position. There's discussions occur over the next 6 weeks or so regarding the prospects of a purchase or a sale by Christmas time. And this, of course, acts to generate the spring selling season. So we've come to the end of the autumn selling season. We're now entering that midpoint of the market, which is typically quieter. We see a much higher proportion, even with lower listings, of lower priced properties. And of course, we have the lengthy mid-year school holiday break as well. That sort of acts together with that. But with the latest auction results, once again, Michael, even though we are starting to see a little bit of a slowdown in listing numbers, it's still very strong results for this time of the year. So clearance rates are similar to where they were last year. You've got to remember, a year ago, we were coming through the buyer surge in the market that came at the beginning of the uptick in the cycle. Typically, we see buyers lead that charge following a period of lower prices. And this year, we're seeing the final part of that cycle, and that's when sellers start to move into the market to take advantage of higher prices and more buyers. So, but of course, most buyers are sellers and sellers are buyers. But certainly that's continued with the latest results with another surge of seasonal listings. Even though the numbers are falling compared to previous weekends, they're still very, very high, not just compared to last year, but compared to any period, any year over this period. So, I think even with the outlook for inflation becoming a little more clouded, that Australians are still very much attached to the housing market environment. And why wouldn't they be, given the chronic undersupply that we're suffering? So let's have a look at the latest results. 721 auctions in Sydney, down a little bit compared to the previous weekend. Clearance rate was actually higher in Sydney, Michael, so a good result there for sellers. But look at the comparisons with a year ago. Not only the auction numbers nearly double, in fact, just under double what it was a year ago, which is remarkable. But the clearance rate was also higher than a year ago. Similarly, Melbourne, just under 800 auctions, clearance rate a little bit lower, 63.4%. And that perhaps affected to a larger degree by school holiday period. But again, just massively ahead, more than double where it was at the same time last year. And the clearance rate not too far away from where it was a year ago either. Brisbane continuing with its typical Brisbane mid-50s clearance rate despite higher listings. And look at the difference in listings in Brisbane this year compared to last year. Again, nearly double the listings and a similar clearance rate. Adelaide continues to produce the highest clearance rates, down slightly, well, really just about the same as where it was a year ago. And despite a couple of very strong weekends for clearance rates in Canberra, back down into the mid-50s in Canberra, but and well below where it was last week, but above where it was a year ago. So Canberra, still a little bit of work to do in its revival. And we'll keep an eye on that over coming weeks. But again, higher listing numbers in Canberra. So when we look at our transfer auctions, Michael, we can see that Sydney a little bit lower than May, but still holding above 70% and lower than where it was during that very strong period a year ago. The Melbourne market actually higher in June compared to May. This is the monthly weekend clearance rate, but again below where it was a year ago. Brisbane, similar to Melbourne, back to a sort of normality in terms of mid-50s. We know that the Brisbane market has a different culture in terms of marketing through auctions and tends to produce consistently in those mid-50s, but just showing how strong that market was a year ago, which was sort of the peak of that migration boom that we've seen drive southeast Queensland through the COVID period. But well below that record 70% reported over June last year. Same story in Adelaide, down a little bit from where it was last year during that real boom period in Adelaide, where it was every month virtually 80% plus clearance rates, but still good results for sellers. And reflecting what's happened over previous weekends, the Canberra now tracking at its highest point since the middle of last year. We need to wait and see whether that can be sustained over July, but certainly some better signs for the auction market in Canberra over the month of June, although it had a little bit of a weaker result last week. And Capital City snapshots available on the Doc Andrew Wilson LinkedIn site around about 6:30 every Saturday night, and Michael publishes the full national auction report on Sundays, which gives you the regional breakdowns for Sydney and Melbourne and the top 10 sales for all the capital cities under the hammer. And as we mentioned, this remarkable surge in listings has continued. That's we can see there over this the first 5 months of this year, the Sydney sales, these are sales, so put listings and auction clearance rates together, and actual sales are up 33% in Sydney compared to the same period last year, up 25% in Melbourne, up 15% in Brisbane, 13% in Adelaide, and Canberra now sales are tracking 3% higher this year so far compared to the same period last year. So some very positive results there in terms of the number of properties going under the hammer or selling under the hammer every weekend. In fact, these are record numbers, Michael, for the first half of the year for actual auction sales. So, again, reflects strong economy, strong confidence in the housing market, And the shortage of housing that we do have is a part of that motivating factor. So there's our National Weekend Report QR code for those that missed it, and we look forward, of course, to our next discussion next week.
Well, interestingly, it seems like buyers and sellers are just putting aside the interest rates and all the economic,
Yes.
and they're just getting on with their lives. I guess they're sick of hearing all this, and they're getting married, getting divorced, having
Yes.
babies, maybe not in that order, and they're just getting on with their lives.
And they know how difficult it is to secure accommodation, Michael.
Yeah.
Particularly those in the rental market, it's a nightmare. The queue for being for getting into the market as a buyer is getting longer. And we're not matching that with home building levels, which, despite all the good wishes for government, just aren't going to occur. So yeah, like perhaps they're not reading the papers anymore, which or wherever they get their news from, because they're like the boy that cried wolf. Eventually, you just ignore it. And as you said, again, we're getting the bounce from those predicting that have been, breathlessly predicting lower interest rates are now changing tack and talking the other way. I still think our outlook is for stable rates. Reserve Bank has said that it needs a consistent period. We are a hostage to what's happening with the oil price to a large degree. So we need to keep a very close eye on that. But given that, Michael, we know that there was a surge in the oil price towards the end of last year. And that means that when we get to the end of this year, maybe we'll get some relief from inflation because of that annual comparisons being in our favour, which it's not at the moment.
Well, catch up with you again next week, and we'll see what happens in the news. Thanks.
Thanks very much, Michael.